and welcome to our latest Insider interview. Today in the studio I have with me Mike Fox, who manages various sustainable funds for Royal London Asset Management. Mike, thanks for coming in today.
You're very welcome.
So Mike, the first couple of questions are related to the Royal London Sustainable World Trust. I can see in its top 10 holdings plenty of stocks seen as AI leaders. AI is of course prompting lots of excitement about its potential growth, but there are also worries about capex. What's your stance?
So it's a great question. I think the fact that we own these in our top 10 suggests that we are more comfortable with the amount of capex that's being spent at the moment. It is unprecedented, it is huge. However, if AI and its potential is true, then what we will see is huge demand for compute as effectively labour gets replaced by computation. And if that happens, we think the scope for growth in compute power and therefore the need for capex is entirely justified.
And of those top 10 holdings, you own TSMC, Microsoft, Nvidia and Alphabet. Naturally, there are some comparisons between the dotcom boom and the AI boom of today. However, is a key difference between the two the fact that those companies that you own, they're very profitable, whereas in the dotcom boom and bust, a lot of the companies weren't making any money at all?
Yeah, I think that's a massive difference. I mean, I started my career in the late 90s, so I did actually see the end of the dotcom boom and bust, and it's night and day from today. There were completely profitless businesses in the late 90s and the valuations were ludicrous. You know, I think today you look at the rating that something like Nvidia trades on, it's on a similar multiple to BAE Systems in the UK. You know, there's no obvious high level of kind of valuation that there was before. They'll be very dependent on how AI progresses and whether the volume of use of AI is what people perceive. But it's not a valuation bubble, which I think was very much the case in the late 90s.
In terms of the country weightings, you have around 60% in the US. What's been your approach, given that there's been a pivot to other markets over the past year?
So, I mean, we're remarkably underweight the US, even with 60% exposure. And I think it's one challenge for a global investor at the moment is you look at index composition, you're really very much weighted to the US and very much underweight other areas. And as the US has become a little bit less exceptional, you know, other markets have benefited. So you're right, you know, Europe and the UK and Asia have been better markets both last year and have started more strongly here. So I think we do want to evolve into that. I do think it's quite critical to say, though, that the US is exceptional and that there aren't really comparators with the same governance standards, the same disclosure standards in other markets. So whilst I do think we will evolve into owning less US and more other markets, it's pretty likely that the US is going to be the main focus for the fund for probably the rest of my career.
The fund has modest allocations to emerging markets and Europe. Could you talk us through some of the exposure you have to those areas?
So companies like Mercado Libre, which is Latin America's largest e-commerce business, it also has a payments business within it as well, is a great example of getting exposure to that market. We also own HDFC Bank, an Indian bank, so exposure to that market. And we're looking at other ideas in Brazil and areas like that. So, you know, you can most definitely find them. But I do think it's like still a little bit by exception. You know, I do think that when, particularly for us, when we're looking through a sustainable lens and looking at environmental, social and corporate governance standards, they do tend to be weaker in a lot of these geographies. So we can find ideas, we do make progress. We also invest in companies listed in the UK and US with big emerging market businesses within them. So that helps as well. And then you put it all back together. And we do think in totality, we have reasonable exposure to emerging markets.
You've been managing money for over 20 years. So you've seen a lot of change over that time when it comes to sustainable investing. How do you think the landscape for sustainable investing will change over the next 5 to 10 years?
So it definitely goes through cycles. I mean, that's my kind of experience of it. You know, a lot of the 2010s, it wasn't really an area that people invested in, but then in about 2017, 18, it really got a kind of tailwind behind it. And then I think partly because of the change of the president in the US, the outbreak of wars and other factors, that it's been de-emphasised to some degree. Against that though, when we meet corporates, they're very much still aligned. They think sustainability aligns with more value-add products, with less cost, because resource efficiency means cost efficiency, and often more motivated employees, many of whom do have values and they want to see those in the companies they work for. So even though from the top down there's a little bit kind of less of a tailwind than there used to be, bottom up companies are still as committed to it. And I think as long as that remains, it should still be a durable place to grow capital and invest.
As you mentioned, around 5 to 6 years ago, there was a big pickup in demand for sustainable funds. And then a couple of years later, we saw that demand cool. And that demand cooled at the same time as performance cooled. So are the two things heavily linked? Do we need to see a pickup in performance for sustainable funds for investors to return?
Probably. I mean, it's one of my frustrations that as the fund gets more expensive, it tends to get more interest, and as it gets cheaper, it gets less interest. And one of the real challenges for any investor is to just think counter-cyclically. It's like what's gone down has more potential to go up, and it's often the mentality is the other way around. So, I do think performance drives everything, and ultimately when people see the performance that they think they can buy into, then they will show more interest in sustainable investing. But even since 2022, I think it's important to say that we've still managed to grow capital quite nicely, even in an environment that hasn't been particularly favourable.
Over time, we've seen some shifts in sustainable investing. One shift we've seen over the past couple of years is the debate over defence stocks and whether they should be included in a sustainable fund. What's your stance?
So I've got 2 points on this. One is that if you take the company I work for, Royal London, we offer our investors funds that do and don't invest in armaments. So the most important thing is it's a choice that an investor makes. Within the sustainable funds, we don't own armaments really because we struggle to find an armaments company where we can guarantee that the weaponry is only used for defence and is traceable. So we fully understand the need to defend democracy, society and all these other kinds of things. But the reality is when we look at armaments companies, once a fighter jet's been sold to a government, that government uses however they want. And that can become very, very controversial into what's attack, what's defence and these kind of debates. So we're just very clear with our investors that if you invest in this fund, that we're not going to be owning armaments manufacturers. But we totally respect the view that people may say, I'm fine with that for justifiable reasons, in which case, we offer other funds that invest there.
I wanted to also ask about clean energy stocks, which you have described as the most obvious sustainable investment. So how do you gain exposure to that area?
Yeah, so the reason why we kind of say it's the most sustainable thing is like literally everything is energy transformed. You can't do anything without energy. So the fact that you can find renewable sources or sustainable sources of energy, I think is a good thing. How you can invest in it, I think it's been super interesting that since Donald Trump was made president on a very anti-environmental agenda, renewable stocks have performed really well, because there is this huge demand for power in the US, particularly around data centers. And things like solar are very practical, very quick ways of dealing with that. So solar stocks, I think, are having something of a renaissance. You've got to pick carefully which ones you own. But things like wind as well, look at SSE in the UK. Some companies do have fossil fuel exposure as well. So SSE has gas generation, which we need to make sure is run environmentally well. But it is possible to buy them as distinct renewable businesses as well as these kind of composite companies as well.
And our final question, which we always ask for managers, is whether you have skin in the game. And before you answer, Mike, as you run numerous funds, I wanted to ask, are there certain funds that you personally invest in, or do you invest across them all?
So I have investments in Sustainable Leaders, Sustainable World and our Global Sustainable Equity Fund. So for me personally, I quite like having the equity exposure. I'm quite comfortable with the volatility and I've still got long enough to invest to manage that. we also run fixed income funds as well, which are for people who maybe want a bit less volatility or have got less time to save. But for me, it's like what I've learned over the 25 years I've been managing money is just the genuine power of innovation and the genuine power of economic and societal progress, and equities give you really undiluted exposure to that, and that's how I choose to invest.
Mike, thank you for your time today.
Thank you.
So that's it for our latest Insider interview. For more in the series, do hit the subscribe button, and hopefully I'll see you again next time.